Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what's going on today. If you want to follow me, at Finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these sectors, looking for investment opportunities, sharing those opportunities with everyone in the community. I also dive into developers, explorers, not so much, they're not my favorite groups, and a lot of the producers across many different sectors: coal, both met coal and thermal coal, natural gas, oil, energy service, shipping, tankers, base metals like copper, nickel, iron ore, steel, copper, everything. If there's an opportunity, I'll look at it. I look at lithium, I look at vanadium, I look at whatever's out there. And if the chart looks good, I bring it up to everybody in the community and say, hey, look, here could be a potential opportunity. And maybe I'll share one at the end in terms of a sector that I think looks really good for an opportunity that people probably should have already positioned. And we've positioned already on the website in some of the companies for this potential opportunity here. And I'll show you what it looks like at the end here. So if you want to sign up, special is the coupon code. It is $25 using that special code for the first month only on a monthly membership. Then it goes to $50. And then on the yearly membership, you can sign up. It's $100 off. It ends up being $500 for the year. You get an entire year and another $500 re-sign up if you want to at that price, if you use that special coupon code. So coming down, macro liquidity. It says oil didn't miss the gold rally. It's been following the real economy, not liquidity. Well, liquidity moves first, then generally the economy goes behind it. Gold doubled from 2000 to 4000, but oil stayed muted because it tracks the copper to gold ratio, not QE headlines. That ratio measures the balance between industrial growth, copper, and financial liquidity, gold, and it's been collapsing. So while gold rose on liquidity stress and capital fleeing to safety, oil followed copper gold lower as real demand cooled and growth expectations fell. It's the same divergence we saw before every major reflation. Liquidity hoarding first, then a violent rotation into real assets. When the next round of QE begins, that liquidity won't stay bottled up in paper markets. It'll flood into commodities, energy, and tangible assets. That's when oil catches up violently. This won't be a normal inflation cycle. It's the start of a soft hyperinflation, where central banks keep printing to hold up the system. But capital quietly abandons paper for things that burn, dig, and build. Gold signals the monetary panic. Oil marks the real transition. Yeah, I agree with that. Gold's already front run the move. That is the anticipation of liquidity coming into the markets. And then you're going to see copper break out. You're going to see oil break out. You're going to see everything break out. And that's kind of what we're at the precipice of. Now, there's positioning going on in the markets already. If you look at the oil companies, they're not at all-time lows. They've already bottomed and are starting to head higher. So if you're trying to buy the bottom in oil, it's already behind you. Now, you wouldn't know that by reading this particular setup here. You wouldn't know by following Twitter. You wouldn't know by following the oil price. But smart money's already positioning. They're already in it. Now look at a lot of the charts in a lot of these different sectors. Look at the individual companies. They are not at all-time lows. They're putting in double bottoming patterns, and they've already bottomed and are heading higher. A lot of the offshore is putting in inverted shoulder head shoulder patterns. We're scribing out the right hand shoulder on that inverted shoulder head shoulder pattern. There are some metals that are still down, base metals and stuff like that. If you're looking around, there are some that are still way down in double bottom patterns. But again, a lot of the stuff has already moved up. I mean, you go look at copper companies, they are ripping. Some of them are. They've already broken out. Now, I'll give a couple examples at the end of this to show you what I mean, to give you a glimpse of what my opinions are on companies. Now, I'm not going to give you any of the juicy stuff that's right at this exact moment. That's for members and for the members to accumulate on the cheap. We got to keep it on the hush hush. But I'll show you maybe some copper companies, because a lot of people think, oh, copper hasn't broken out yet. I've got all this time. I'll show you a couple equities and what they're doing. Coming down, it says, I had a very interesting interview with Harry Dent, a contrarian economist, American financial newsletter writer, and businessman. Gold is bubbled. Harry Dent dumps gold and real estate. Buy this instead before a 90% crash. Why are people still interviewing this guy? I mean, he has been wrong ever since the last real estate bubble. He's been calling for a bubble since, heck, it's been like 2012, 2013, somewhere in there. Every year, bubble, 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 bubble. I don't know what the heck he looks at. I don't know, cocaine's a hell of a drug. I mean, maybe that's the case. I don't know what is going on here. I mean, he's been calling for a bubble every single year. So to interview him and give him, a little bit of airtime, I mean, that's all he says is bubble, bubble, bubble. So who the heck knows? I wouldn't listen to it. It says, learn this early, master it, and the world is your lobster. It says, never let a profit run into a loss. More traders are ruined by violating this rule than any other except over trading. When you buy or sell a stock and it shows you a profit of 3 to 4 points, what is the sense or reason for ever risking any more of your capital on it? Place a stop loss order where you will get out even or better. Then you have all to win and nothing to lose. If the trade continues to move in your favor, you can follow it up with a stop loss order. People often buy or sell a stock and it shows them a good profit, but they are hoggish, expect more, hold on and hope, and let it run into a loss, which is very poor business. And the man who follows it will not succeed in the end. Always protect your principal in every way possible. Okay, I'm trying to formulate how wrong this is. I'll just say this. Trading does not make you money. And what I just read here on Twitter is an absolute garbage. Do not believe in this garbage. Tell me you don't know what the hell you're doing without telling me you don't know what the hell you're doing. That is what that paragraph is right. It means to me. You have no idea what the value is. You have no idea what you're literally just going around chasing price. And if the price moves back against you, you got to put a stop loss and do this. Guys, that's not how you make money. That's not how you build wealth. This is not the way to do it. This is absolute trash. Absolute garbage. Like, read this 4 or 5 times, and that's exactly what you don't want to do. Absolute trash. My approach and the way that I would go about it, you need to know where things are cheap. You got to go where there's value. Then you have to be incredibly patient. I've been in beginning positions where they pull back on me, and I'm not exactly right in the beginning. A lot of people would say, well, you should have put a stop loss on it. You should have been stopped out at a 6% loss. Do you know what the volatility is in half the companies that I go into? You could be down 6% in an afternoon, let alone 6% over like a week or two. There's been positions I've put on where I'm down 30% in the beginning for whatever reason. It could be anything. It could be dilution. It could be an earnings call that, I don't know, people just sold on. It wasn't even a bad earnings release. It could be anything. And then I hold on to it. And then a few years later, when I'm looking back and I'm up 3, 4, 5, 600%, are you telling me I got hoggish? That pigs get slaughtered? I I don't. The more I learn, the more garbage that I see. And all of this trading crap is just garbage. What I would do if I were a new investor, this is what you need to learn, in my opinion. You need the three pillars. Learn the cycles. And this is not easy, guys. It is not easy because even if you know the cycle, even if you know what's driving some of this stuff, you're going to have all these people running around you talking about price movements in the short term. So you're going to have to avoid and basically not listen to all of that information that they're spouting out of their little mouths. And these are people that do not make a lot of money. You want to follow value. Avoid overvaluation like it's the plague. Run to undervaluation. Buy when people are afraid. And you're going to have to look for technical patterns. Buy when the sector is underneath its cost curve. Buy when it's cheap against other sectors. And if you follow that and you're really patient, because everyone is impatient, they can't wait. They're all doing this crap where if it shows you a profit of 3 or 4 points, give me a break. I did an 8x on a portfolio. It's not realized gains. It was unrealized gains. I 8x'd an entire portfolio in a little over 2 years. It was between 2 and 3 years of late 2020 all the way up to 2022. Now, we've been consolidating and I didn't sell. Why didn't I sell? Because I don't want to pay taxes. Taxes is a way to take purchasing power away from you. It takes shares out of your account. So I've been holding. I've given a little bit back. And now, well, since 2020 to 2023, I gave some back and then it came back up again. And now I'm back to all-time highs. You don't make money by trading. That's what I'll say. You make very, very little if you're good. The big money is made in sizing the big trends and getting the big cycles correct. And then buying an extreme undervaluation. An extreme undervaluation comes when there's fear in the market. That's what you're taking advantage of. So really what you're doing is you're looking at everyone else and you're behaving the exact opposite of their behavior. When they get scared and they sell because prices are going down, you have to step in a big way and buy it. It's hard to do it though, because everyone is scared. Here's a Bollinger banter. Iron ore once higher. I wonder who's been talking about iron ore. Me, myself, and I. Iron ore looks very good. This is probably going to turn into a shoulder, head, shoulder bottoming pattern. It'll eventually break. And I've already positioned. I've already positioned in this sector. Do you hear people talking about iron ore that often? Nope, they don't. It's like this hidden sector that no one knows about. Do you know iron ore was one of the top performing commodities in terms of the equities back in the last bull market of 2000 to 2011? I should say 2000 to 2008, and there was a big dip there, but we'll say 2000 to 2008. One of the best performing sectors. Michael says, eye-opening chart. It says there's no such thing as a gender pay gap. It's married men making more than everyone else. What is causing such divergence? Are married men simply more responsible and hardworking? Or is it something else? Well, I'll throw this out there. I'm willing to bet that women choose certain types of men, and the probability of those types of men being married goes up. So it's not that married men make more money. It's that they made more money before they were married, or they had the potential to make more money, and women seeked those men that made more money. So I'm willing to bet. I mean, well, this would be the proof in the pudding, but I'm willing to bet that there's more married men in the top 10% that maybe skew this as well. So there could be a lot of very high earning males where females just throw themselves at them and they decide to get married. Yes. So that's my guess. That I don't know if that's true, but that's my guess of what's causing the divergence is that women choose to marry men that make more money and they become married men. Coming down, Boilinger banter again. Natural gas, strong move into resistance. Energy picking up across the board. We set early for this, you were told. Yeah, we've been looking at these particular companies already, and we positioned a while back on the website. I haven't been like super bullish on nat gas. I think it's going to go way up. Totally agree. But the companies, when we purchased them, were way down, and they never came all the way back down. They're still up 100, 200% from where we purchased, at least their lows. So it'd be somewhere between 100, 200% where most people got in, and that's kind of what they're up. Maybe it's a little bit less than that, depending on the company. But usually when you get a really good entry point, I just let it go. And then I don't really go back to it, because if there's other better entry points, then I go after those. So again, everything is a function of opportunity. So if you've got really, really good opportunities in other sectors, although natural gas is a great opportunity, I may take something that has better risk reward traits or characteristics in the chart. That doesn't mean that natural gas isn't a great opportunity. It is. But everything is a function of opportunity, and you should be allocating money based off of the function of that opportunity. So that's your position sizing and everything. It's all based off the opportunity. It has nothing to do with the sector necessarily. It deals on what you're paying for that asset. So you can have a cheap commodity sector, but if the asset isn't cheap that you're trying to buy, the equity that you're buying, that might not be the best opportunity, even though the sector could still be cheap, like natural gas, for example. You want to buy the opportunity. If there's some weird, I'll just make it up. If there's some really weird opportunity where someone's foreclosing on a house and it only comes along once every 20 years, that is a function of opportunity. That's when you have to jump on it. You can't be like, well, I'll just wait. Someone else buys it and then it's gone. And let's say that opportunity, the house was ridiculously in a ridiculously good neighborhood, in a really good setup, really great view, and you could buy it for 50, 60% off, foreclosure or something like that. So that doesn't come all the time. And you have to jump on the opportunity when it's there. So that house was a great opportunity because of the price that you could have paid for it. Now, at some other time, it's the same house, but you don't have the same opportunity to buy it for the price that you could have. So you might be paying a 10% discount versus a 50, 60% discount, as an example. Scott Besant on rare earths. It says, you're not bullish enough. China has been putting their rare earth plan together for 25 years. The U.S. has been asleep, but now this administration is going to move at warp speed over the next 1 to 2 years to get out from under this sword. Well, if you go and you look at some of the rare earth companies, they've already moved massively. So when it gets in the news on Twitter here, it's already kind of too late. Your risk reward is done. It's not a great opportunity anymore. You have to get things when people aren't looking. And then you have to be patient enough for it to play out. So Seth says, if you hang around six fools, you'll be the seventh. If you hang around six liars, you'll be the seventh. If you hang around six failed prognosticators, you'll be the seventh. Better off hanging around six savvy investors, you'll likely be the seventh. So this is David Hunter, and I'm not necessarily picking on him, but there's a lot of people trying to make these calls. He said, this is in 2016. Yes, I'm still saying it. S&P to fall to 500 and global deflationary bust in 2017. 2-year top is now complete. What unconscionable looks like. These guys have been saying the same crap over and over and over. I've seen people, Henrik Zaberg, David Hunter, all of them. Now, I'm not stating that they are bad people. I'm not stating that at all. What I'm stating is that a lot of people listen to them on YouTube and they try to make investment decisions based off of their opinions because they are perceived to be experts. I'm going to tell you a little something. I used to do what you guys did too. And what I found is that these guys make a lot of wrong predictions. A lot, like all of them. So it didn't work. I got so frustrated that I developed my own approach, my own strategy. And that approach or strategy, I think, is far more, it produces far better returns than trying to listen to these experts. I'm not stating that it's get rich fast. It is an approach to the market where you base everything off the opportunities, you size them up, and then you invest and you be patient. It's kind of it's a mix of, you're using technical analysis for entries, but you're also being patient and using value to protect your investment. It's a little bit of a mix between Warren Buffett, Munger type investing and Howard Marks and Peter Lynch, which is the value side, and then a little bit of technical analysis to try to time your entries as best you can. I try to stay away from these prediction callers because I've listened to them throughout all the years, the Harry Dents, the David Hunters, the Peter Schiffs, whatever else. And I don't think it's right. So I had to take all of that stuff out. I had to take all of the news out. And one of the pillars is technical analysis. And that's really what I'm using to ascertain what the market thinks. And I do it across many different charts. Then I aggregate it up and come to a conclusion. And the cycle, aggregating up all those different charts will tell you where you're at in the market cycle. And that's another one. Where are you at in the cycle? And then the other one, which is ratios, is kind of a value slant using technical analysis. So it's what is cheap in the market. And I'll show you one of the cheap areas if you guys want. We've already taken a position on the website and I'll show you what it looks like. So you get an idea of what I do. High heat. U.S. oil decline rate is going up because we keep layering on more high decline rate shale wells. Raymond James. Yeah, so if you're replacing or you're putting on more and more new production with high decline rates, well, then the total decline rate is going to go up. That makes perfect sense. Your average decline rate goes up when you add in really high decline rate fields. Duh. Macro liquidity. Equities priced in dollars can lie. Liquidity, leverage, and illusions can make them sing. But when priced in gold, they can no longer hide. Every cycle of suppression only reshaped the crisis, never erased it. They tried to avoid a Great Depression, we got stagflation. They tried to avoid stagflation, now they risk hyperinflation. Each rescue inflated the next illusion. Each illusion demanded a bigger rescue. We are again at that turning point where numbers look stable, but the truth whispers through gold. When will policymakers learn that you can't print trust? Great Depression, stagflation, and then we have another that he has hyperinflation here. So it could be. I don't know. We'll see. But that's gold divided by the Dow Jones, and it's rolling over, ready to make a big move to a much, much lower area. We are positioning for this. That's one of my key themes. It's the cycle that peaked in 2000, headed lower. We had a nice little, A, B, C correction. Is going to go all the way down probably. Please, people, this time is not different. It's never different. Yields going down, way down. Nothing stops the macro train, even the printer. So in his opinion, he thinks that yields are going to head lower. This is the 3-month government bond yield. They've been heading a little bit lower in the short term. I'm not sure what's going to happen here in the short term, guys. It sure looks like he could be right. Maybe the yield curve or maybe lower yields do come. On the long end, they look like they want to go up. So I'm not exactly sure what happens here in the short term. I would, if it were me and I were to put a guess out there, I don't think yields are going to go down that much if they are going to go down. So this was in a declining interest rate environment, every single one of these, and this one isn't. So even if we go down, I don't think we're going to go all the way down here. I think maybe we could go to like 2.5%, maybe the peak here. So we do like a breakout retest. Maybe that's the case. So, I went over that last time there for Sam. Here's an opportunity if you guys want to see what I do. This is met coal divided by gold. Not a lot of people talk about met coal. This here is kind of a base and it's really low. Here's another base and it's really low. What do you think we're doing right now? We've got a nice little squeeze up into a falling wedge. And we've got, look at the move higher here, but this is going to be a bottoming pattern. It usually occurs in these bases here. So you'll get a kind of call this like a base, and then we'll create a base here. And eventually we'll break up against gold. That's money. So gold moves when there's liquidity in the system. So that's what this move is here, that big move lower. The falling wedge is when the buyers equal the sellers, and then your bottoming pattern occurs usually at these tips here, which we're undergoing the bottoming pattern right now. Your entry point is in here. It's all through here. Now, we've already bottomed in the equities that I'm interested in, so they're already heading higher. So we've already positioned for it. So this is the things that I look for on the website and try to get you guys a leg higher to get those entry points. Now, there's other sectors at this time, and this is still a great opportunity. I think we're going to move on up over time. But there are other sectors that are even, at this point over here that are just starting to break out of this tip here. There's a few sectors that are right there. So that's the opportunity that you need to jump on. It doesn't mean it will go up immediately. Some of these are, they're going to bottom. We buy them in the base, and they break out, and they may still consolidate some. Investing, by its nature, is really boring. A lot of people, what happens to them is they get frustrated, and they lose the position because they're impatient. MP Materials was one of the companies that we had purchased. Just to show you, this is your falling wedge. This is your entry point in this bottom here. What we were looking at in met coal is in this location right in here. This is where you want to enter in a company, and this is the outcome, a big move higher. Now, it doesn't mean that the outcome will always be that, but this took about a year and a half for it to play out. If you got in at 16 down to $12 or something, and it went all the way up to almost 100 for a short period of time. But those are the types of scenarios. And now I'm buying companies that are down here. That's where we're going. So when you look at this, I call it a fractal or pattern, and we go back to sorry, I forgot the so met coal versus gold. This is your entry. It's through here, and then you have to go into the equities and start looking for your entry points. So if you want to sign up, and again, I'm just giving you guys an idea of what I'm doing. I'm buying these bottoms here. And we've already positioned in met coal, and some of the companies are up quite a bit. But there are still opportunities out there that are in other sectors that are like right. I mean, you can get them right at the bottom. So just wanted to share that, guys. But that's all I've got for today. Thumb up for the content, subscribe to the channel, subscribe to the website if you like. Specials a coupon code, and we'll catch you next time. See ya.